Hello, everyone. This is Annalena from the New Mexico Small Business Development Center. Today, we have Ian Alden joining us, who's an attorney that specializes in tax law. Mr. Alden will be discussing COVID-19 related tax credits for small and mid-sized businesses. Thanks so much for joining us. And without further ado, I'll hand it over to Mr. Alden.
Good afternoon, everyone. I'm happy to be with you again for this workshop today. Before we get started, I'm going to just point out a few COVID-19 related resources for businesses that you may want to avail yourselves of. There's a lot of good guidance and resources out there to help you run a COVID-safe workplace, especially these days as things are opening up again. It's more important than ever to make sure that you are keeping up with all of the latest advice from the CDC, OSHA, and whatnot. So be sure to check out the resources on this slide. You can get a copy of the slide deck from the SBDC, I believe. So if you need to get access to some of these, just pull them off of this slide. So before we get started, I just want to point out a few things. Your microphone should already be muted. If for any reason yours turns on, please mute it. Make sure your zoom ratio is set to fit window. That's so you can see everything on the slide. Some of them are stretched out a little bit. We will be using the Q&A function to take questions, not the chat. So please deposit your questions using Zoom's Q&A feature. I'll be answering questions throughout the presentation, and I've reserved a few minutes at the end to do the same. So go ahead and write down your questions as they come up, send them in the Q&A. Be sure to point out the slide number. You can see it on the bottom right-hand corner of the slide. That way I know what topic or material you've got a question about. So, of course, this training will go over some of the COVID-19 related tax credits for small and mid-sized businesses. I will point out that the description of this workshop listed a few things that we will not be covering today, specifically depreciation, special depreciation, and other general tax provisions that are more or less in place even outside the pandemic. I got a lot of requests when we announced this workshop to focus on just a few key tax credits that are part of the COVID-19 relief bills. So we're going to focus on those today, but I'd strongly recommend that you reach out to your accountant or CPA to go over all of the different tax credits and deductions you're entitled to, because there could be a lot you're leaving on the table here, and we want to avoid that. Some upcoming training and counseling services. We've got the Profiting from Social Media workshop on April 2nd, the Essential Considerations when Buying a Business on April 5th, Breaking Down the Shuttered Venue Grant on April 6th, and then we've got Top 10 Online Scams Every Business Must Avoid on April 6th. So plenty of training upcoming. And as always, the SBDC is offering no-cost business counseling and loan application assistance. Highly recommend checking out the resources SBDC makes available to you. It again is one of those things where you're leaving money on the table potentially, or opportunity on the table if you're not availing yourselves of these resources. So be sure to check it out. So the first thing we're going to cover in today's presentation is just a bit of background on tax credits and how they work generally, because it's important to understanding why you'd benefit from the credits that we're going to talk about. So to cover tax basics, there's a few key concepts you need to understand. Gross income, it's basically your income from all sources in a given year. Wages, dividends, capital gains, business income, retirement distributions, etc. Just whatever your income might happen to be in a year, you just collect it all, and that's your gross income. Adjusted gross income, it's a term I'm sure you're all familiar with from doing your own tax filings. It's your gross income minus certain adjustments, above the line adjustments, for example, educator expenses, student loan interest, alimony, retirement contributions, and certain self-employed health insurance and self-employment tax payments. Those could all be considered reductions to your gross income, subject to certain limitations. Your taxable income, it's your adjusted gross income after you apply other exemptions and deductions And it's your taxable income that's ultimately subject to taxation at whatever your applicable tax rates are, your marginal progressive tax rates. Um, Now, deductions reduce your AGI to get you your taxable income. The most common example is just the standard deduction that people can take. It's $12,550, if I'm remembering right, this year for individuals. So that's a common deduction. You apply that to get your taxable income, and then you pay tax on your taxable income at your progressive tax rates. I'm sure you've all dealt with this in the past. This isn't probably new information for most of you, but it's important to understand all that to understand what tax credits are. Because if you look at your taxable income and then you figure out what your tax is after that, I mean, just breaking down gross income 60,000, let's say you threw 10K into a retirement account and then you've got your personal deduction, your taxable income, if nothing else applies, is 37,450, which you'd be taxed probably at, you know, 10 to 12%, 10% on the first 10,000-ish dollars and then 12% on the rest. But credits, tax credits, which is what we're going to be talking about today, are dollar for dollar offsets against the taxes that you owe that's calculated from your taxable income. So as you can see in that hypothetical, I calculated the federal income tax based on progressive rates to be $4,295. A credit would directly reduce the amount of tax owed there. So if you have a $2,000 credit, it eliminates your tax debt dollar for dollar. So it drops down $2,000 with a $2,000 tax credit. Now, tax credits, they're typically more valuable than deductions because, again, they're a dollar for dollar offset of a tax liability, whereas a deduction will only reduce the amount of income that can be taxed at a certain percentage, like 12%. So credits can be much more valuable. They're also valuable because they're often, but not always, refundable, meaning if the credits exceed your tax liability, you get paid the difference. One common example is the earned income tax credit. Another common example is all of the credits we're going to be talking about today. They're refundable. So, if you're entitled to a tax credit, say the employee retention credit, and your taxes aren't enough for the credit to offset, you've got more credit than taxes owed, you get paid the difference. That's what it means to have a refundable tax credit. And that's why we went over these basics just now. Because I want to be clear that these benefits extend beyond just your own tax liability. You can actually get money in your pockets with these credits. Another thing about credits is that they're sometimes payable in advance, meaning if you're looking, for example, at someone's income in the year 2020 to determine if they're eligible for a credit that they're paid in 2020, that's an example of an advance credit. Common examples is the advanced premium tax credit with the Affordable Care Act. The government will subsidize health insurance premiums for the year based on someone's expected income for that year. If their income turns out to be less, they might get an additional refund of the credit. If their income turns out to be more, then they probably received more in advance credit than they were entitled to, and they have to pay some of that credit back. That happens all the time with the Affordable Care Act credit. Another example is the recovery rebate credits, also known as the stimulus payments. Everyone got, $1,200, $1,400, $600 in chunks last year and this year based on their expected incomes for last year and this year. So some people whose incomes last year pushed them out of eligibility for those credits will have to pay those credits back. That's just the way those advance credits go. And the same will be true for the credits we're talking about here to some extent, though, since they're not based necessarily on income and they have triggers, there shouldn't be a repayment issue like there is for some of these others. Now, the first credit we're going to talk about today is the employee retention credit. This is a credit created by the CARES Act. It's designed for essentially for employers to keep people on the payroll. It was one of two initially alternative ways of keeping people on the payroll. One was the payroll protection the PPP loan that a lot of businesses took last year. For those businesses who weren't eligible for the PPP loan or otherwise couldn't take it for whatever reason, there was the employee retention credit. I'll say that they were created as an either or system, but with later stimulus bills, that was changed to let you take the employee retention credit even if you took a PPP loan. So they're no longer either or. And so it's worth taking a second look if you haven't already claimed that credit. Talk to your accountant and make sure you're claiming whatever you're eligible for. Now, the credit, um, it's gone on into this year, 2021, thanks to later stimulus bills. What it does is it provides on a quarterly basis up to 50%, a credit for up to 50% of qualifying wages paid in 2020 in each quarter, and up to 70% of qualifying wages paid in 2021 per quarter, up to $10,000 in qualified wages for businesses that have been financially impacted by COVID-19. If you look at this in real dollar value, if it gives you a credit for 50% of $10,000 in wages paid per quarter, it's a credit that's valued at up to $5,000 per quarter per employee for 2021 and $7,000 per quarter per employee for 2021. So 50% for 2020, 70% for 2021. That could amount to, just doing the math here, $20,000 in credits per employee per year in 2020, and then 28,000, maybe 21,000. I think it only goes through September. That's the deadline's on another slide. Maybe it goes through, no, it goes through 2021. So $28,000 per employee for 2021 would be the value of the credit. Obviously, that's not small change. It's worth claiming that credit to the maximum extent you're entitled to. But you have to look at whether or not the business qualifies, whether it's been financially impacted by COVID-19 under the language of the statute. And you have to make sure that the wages are what's called qualified wages. I'm assuming that I'm not dealing with any business owners here who have more than 100 employees. I will say the definition of qualified wages differs if you have more than 100 employees. And if you fall into that scenario, I'd recommend reaching out to your accountant or a good tax attorney to discuss your situation. But for anyone with less than 100 employees, you'd fall into this first definition we're about to go over. Now, private sector businesses and tax-exempt nonprofits are eligible if they were financially impacted, which means that they have operations that were fully or partially suspended during any calendar quarter for eligible quarters due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID-19, which you think public health orders that shuttered whole businesses. If your business was shut down, you would qualify automatically in the quarters in which you're shut down. Alternatively, if you experience a significant decline in gross receipts during a calendar quarter, that makes your business eligible. I see we've got a question here. What if it's only the owner in the business? That's a great question. You typically have to look at the wages paid to the owner at that point if we're talking subchapter S corporation. This particular credit doesn't have a lot of mechanisms in place for self-employed people. We'll go over that a little bit later in the slides, but this really is contemplating W-2 wages and certain amounts paid to independent contractors, which I'll go over. There are some self-employment provisions we'll get to. So when we talk about significant decline in gross receipts during the calendar quarter, we're looking at a decline of less than 50% for any quarter in 2020 versus the relevant quarter of 2019. So if your receipts for a quarter in 2020, any quarter in 2020 were at least 50% less than, or I'm sorry, If your receipts were less than 50% of what they were for a calendar quarter in 2019, for the same calendar quarter in 2019, that creates the significant decline that qualifies you for the credit. And that qualification or entitlement goes back to the quarter in which you first experienced the decline. So, you're measuring the quarter once the quarter is finished. But if the quarter once finished shows that decline, your eligibility goes back to the beginning of that quarter. They modified the standard for 2021 to make it easier. So if your receipts are 80% or less in a quarter in 2021 than they were in the relevant quarter in 2019, you'd qualify in that quarter. So it actually made it a little easier to qualify because you need to experience a decline of 50% for a 2020 quarter, only a decline of 20% for a quarter in 2021. Now, it's important to note that the decline, you're eligible for this credit each quarter in which you're experiencing the decline. And then your eligibility goes through the quarter in which your revenues recover. So if your revenues recovered, for example, in Q4 2020 to be more than, the 50% of what it was in 2019, your eligibility goes through that quarter so that even though you didn't have that financial hardship in that last quarter, you still get the credit. It gives you a kind of recovery quarter. Also, keep in mind that with the shifting standard for 2021, you might have a situation where your eligibility ends in Q4 2020. You get to claim the credit for Q4 2020 anyway. And then in Q1 of 2021, if your receipts are less than 80% of what they were in Q1 2019, you get to claim the credit all over again. It's not a situation where once you become ineligible, you're never eligible again. So you look at qualified wages, and this is kind of where we get into some gray areas here. It's compensation. Wages and compensation is defined by the Internal Revenue Code. So your traditional wages, salary, and other compensation. Property for services would be considered wages here, depending on the fair market value and whatnot. Things like that. I mean, wages is kind of an expansive concept, but qualified wages here also includes healthcare costs, even if no other wages are paid. This is important for employers who may have furloughed employees but kept them on the health insurance plan and subsidized their premiums. The subsidies that you paid for those premiums count as qualified wages for purposes of this tax credit. That's helpful for a lot of people who are in that split situation where employees were furloughed but kept on the health plans. Now, claiming the credit, it's a bit thorny because Form 941, it's the quarterly payroll return that you file with the IRS. It was amended by the IRS to let you claim this credit. There's a certain fields on there that you fill out to provide qualified wages and entitlement to credit. Once you figure out what your entitlement is, you can withhold from the IRS certain payroll taxes. It should have been, if I recall correctly, Social Security taxes for 2020. You would withhold from payments to the IRS as to satisfy your entitlement to the credit. You can also file a Form 7200, advance payment of employer credits due to COVID-19. This is where the advance credit thing comes in. Basically, it's an advance credit that you'd be entitled to, so you can request that the IRS pay you that money if what you would owe in taxes to the IRS isn't enough to, get you the full credit you're entitled to. Credit withheld from certain employer-side payroll taxes, Social Security taxes for 2020. They shifted it to Medicare taxes for 2021. Absolutely talk to your accountant when it comes to claiming this credit if you intend to withhold payroll taxes from the IRS, because it can be a tightrope to walk to make sure you're not over withholding from them. Because if you are, it's a violation of your obligation to withhold and pay payroll taxes to the IRS. I do have some clients who are simply paying everything that they withhold to the IRS and then claiming the full value on the Form 7200. It's up to you how you ultimately choose to do this, but this is one of those things where an accountant is worth their weight in gold. I'm an attorney. I'm not an accountant. I'm not self-promoting here. I just really think that they're a useful resource and when you're dealing with these things. We've got a question in the Q&A. So this is an interesting question. You're a restaurant owner and you haven't shown a decrease in sales, but the dining room is closed. Are you eligible? I mean, I'd have to look at your situation more thoroughly, but off the cuff, I would guess no, because your business wasn't closed, your method of operation changed, but you're still doing business. And if you haven't had a decrease in revenue sufficient to entitle you to the credit, your your profitability, your ability to stay open hasn't, in as far as this credit is concerned, been impacted such that you'd be eligible. That's my off the cuff answer. Again, it's worth looking a little closer at your situation, but probably not. So a few recent changes here. Let me see what my time is. Okay. Some recent changes here. This credit was supposed to expire in December, but it was extended by subsequent sorry, let me finish this slide and then I'll take whoever's raising their hand. It was extended through 2021 by this most recent stimulus plan, the American Rescue Plan Act of 2021. As I mentioned at the beginning, this used to be a mutually exclusive opportunity. If you took a PPP loan, you weren't eligible for the ERTC. The thought being it's a form of double dipping where you're getting the PPP loan and claiming a tax credit from the IRS for virtually the same thing. If you had the PPP loan, it was meant to cover your payroll expenses anyway, so that you weren't on the hook for them. It was the more valuable of the two because the PPP loan could pay for all of the wages for at least a short time, though the ERTC, as extended, lasts for longer. But with latest stimulus bills, they're no longer mutually exclusive. So if you took a PPP loan, you can go back and claim the employee retention tax credit with a caveat. Qualified wages are predicated on payroll costs that the PPP loan was intended to be used for. So your eligibility for the ERTC, it's a percentage of qualified wages paid. Again, 50% of up to $10,000 in wages per quarter in 2020, 70% of qualified wages up to $10,000 per quarter in 2021. You look at whether or not you've paid $10,000 per quarter in qualified wages. Any PPP loans that were used towards those wages makes them unqualified. So the only way you would qualify for the ERTC after having used the Paycheck Protection Program loan is if you paid wages in excess of what the PPP covered for any particular quarter. And that's bound to be true just because the PPP proceeds were only usable in what's called a covered period. So it's very likely that you had quarters for which no PPP proceeds were used. But for those quarters in which the loan proceeds were used, you can't double or triple dip, as it were, by claiming the credit for wages paid with PPP proceeds. That's a no-go. Now, I know someone raised their hand. I'm not sure who that was. If you have a question, please just type it into the Q&A. That's just going to be the easiest way for me to answer them.
Ian, if you'd like, I can allow that person to talk. It looks like this is the same person that had asked you about their restaurant. Would you prefer the Q&A or should I allow Ashley to talk?
That would be fine. You can let them talk. If you wouldn't mind handling the hand raises, I'm just not sure how to do that.
Yeah, of course. Ashley, I'm going to allow you to talk. You'll have to unmute yourself. Let's see if we can get this sorted. You should be able to talk. You'll just have to unmute yourself.
Oh, I'm sorry. You guys were in my pocket. I totally didn't even mean to hit the button. I apologize.
Oh, okay. No problem. Thank you so much, Ashley. Appreciate it.
There we go. So then a few other notes on this credit before I move on to the next ones. Some of these provisions really contradict each other in the statutes and in the guidance offered by the IRS. These things were really hastily written. I mean, I don't have to tell you all that. I'm sure you followed the news. These things were written in the span of days or weeks, and we're talking thousands of pages of legislation. So there's some contradictory language. The IRS can't keep up with the changes in each stimulus bill. So if you look at the IRS guidance on this, it's already a stimulus bill behind. And that's just kind of the trend. I expect they'll catch up in a month with new guidance, but we're waiting on guidance from the IRS and Department of Labor on a few things. So we'll see what they come out with. But just know that there's going to be some fly by the seat of your pants situations as we figure out mechanically how these credits are working going into 2021. And it's not just the employee retention credit, but all of the credits I'm talking about today. The ERC is actually fairly simple in how you claim it and what the rules are around it. These other credits that I'm about to get to, not quite so simple. So the next ones we're going to talk about is the employer paid sick leave credits and the employer expanded family and medical leave credits. I'm talking about them in a single section because they're really intertwined. So the first one, I'm sure you all heard about the mandate that was passed last year by the federal government and then certain mandates by the state government that have been in play to make sure that employees who qualify are offered paid sick leave for COVID-related reasons. The policy rationale should be obvious to everyone. You don't want an employee sick with COVID showing up for work because they need the money to pay their rent. Just bad pandemic management. So that's what happened last year. There was there were a number of mandatory sick leave requirements, some of which, at least at the federal level, expired in December. But these credits lived on for employees who are voluntarily continuing to provide sick leave. It was kind of a carrot and stick approach, but the idea with this EPSL credit, employee paid sick leave credit, it's a refundable tax credit available to any employer with fewer than 500 employees who pays qualified sick leave wages to an employee who is unable to work, which includes telework. They have to be unable to telework as well because of qualifying reasons, which I'll talk about in the next slide. Eligible employers can claim the credit for EPSL provided to an employee for up to 2 weeks of sick leave, up to 80 hours at the employee's regular rate of pay, or if higher, any applicable federal or state minimum wage with a cap. The if higher language is because you might have some employees who are, for example, servers who are paid, $2-3 an hour minimum wage plus tips or gratuities. The idea is to bump this up to a higher minimum wage if what you're otherwise paying them is lower than the regular minimum wage. There's a cap, which is up to $511 in wages per day, up to $5,110 in total. That's still a decent amount of wages per day. You just don't want to go nuts with it. Some qualifying reasons for the credit. There's a number of them, and I'm including all the reasons that have been added in subsequent legislation, like this most recent one. If the employee is under a federal, state, or local quarantine order or isolation order, advised by a healthcare provider to self-quarantine, if they have symptoms of COVID-19 and are seeking a diagnosis, if they've gone to get tested, if they're receiving a COVID-19 vaccine, actively receiving it, if they take time off of work to go get the vaccine, that time they take off within reason is qualifying sick leave. If they're suffering from adverse effects of a COVID-19 vaccine, I've gotten my vaccines. I won the vaccine lottery and got mine. And I'll tell you, after the second shot, it knocked me out for a day. That is qualifying sick leave. If they're awaiting the results of a COVID-19 test or diagnosis after coming into contact with someone or at the employer's request, it's qualifying sick leave. So if you tell your employee, go get tested, that is qualifying reason for sick leave. The credit is per employee, so you can claim the credit for each employee who is taking the sick leave. Now, it also extends It also extends to some forms of family leave, which is an interesting situation. We're going to talk about how this dovetails with the family leave credit, because the family leave credit is a separate credit. Um, Now, if the employee is caring for an individual who is subject to a quarantine or isolation order, if they're caring for a child, if their school is closed, or daycare has been closed, or if a child care provider is unavailable due to COVID-19 precautions, um, time taken off to care for a child will qualify for this sick leave. Also, an employee experiencing any other condition, um, this is kind of a vague one. Basically, if they have something that's COVID-19 adjacent but isn't quite COVID-19, the idea is we don't want to discriminate against potential variants. So that qualifies. Um, the difference being, if an employee qualifies under these family leave provisions instead of what's typically sick leave, the pay decreases. And I'm going to go back to the previous slide to go over what that pay was again, just so you see it. Um, Credit is up to $511 per day, $5,110 in total for sick leave, up to 2 weeks, full credit. So, it's a tax credit for employers to provide this sick leave. But the credit for family leave, if you're claiming it, it's up to 80 hours, still 2 weeks, but it's only at up to 2/3 of the employee's regular rate of pay, or up to $200 per day, or $2,000 in total. It's not full employee pay. The caps are much lower. Obviously, 200 versus $511 per day is much lower. So if they're taking this for family leave instead of sick leave, the amount that you'd be entitled to in terms of credit for their sick leave decreases substantially. Now, you can still pay them more than that in sick leave. It's up to you how much you ultimately pay them, but you can only claim a credit up to these limitations. So keep that in mind, that what you can claim in credit varies based on why they're out of work. Now, we talked about all that. Let's talk about the employee paid family leave credit. It dovetails significantly with the sick leave credit, more so since this latest recovery and stimulus bill. Employers are entitled to a paid family leave credit for EPFL provided to an employee equal to 2/3 of the employee's regular pay, or up to $200 per day, up to $12,000 in total. Up to 12 weeks of qualifying leave can be counted towards the family leave credit. Now, this was originally a credit that was meant to supplement the sick leave credit. The idea being that initially you could qualify for up to 12 weeks of paid family leave. This is an extension of FMLA, which we'll talk about. But the first 2 weeks of the EPFL had to be unpaid. The idea was that someone would first use 2 weeks of the sick leave for family leave purposes. So they would use the employee paid sick leave credit for those first 2 weeks. And then if they were still out, they would transition over to this emergency paid family leave credit. It's basically like paid leave or FMLA. You exhaust your sick leave or other PTO, and then you go on FMLA typically. They changed that with the latest recovery bill. They're no longer one and then the other. They still can be, but you no longer have the first 2 weeks as unpaid leave. Got a question in the Q&A. I'm a manager for a small gallery that operates on volunteer labor except for 2 contract labor persons. Those are the manager and cleaner. Are any of these tax credits available for us? We did have to close and we had significant losses in 2 quarters. I do not have a mic, so I cannot talk. So I would say the employee retention credit might be available to you to the extent you paid wages during any qualified periods where you either closed or had a significant decline in revenues. There's a separate calculation in place for independent contractor pay, but yeah, you may well be able to claim the ERC in that case. I don't believe you'd be eligible to claim the any of these paid sick leave or family leave credits because they're based on wages for employees and specifically employee benefits. Sick leave is an employee benefit that you wouldn't confer on independent contractors for tax and legal reasons. If you give them sick leave, they're not independent contractors, they're misclassified employees, which I talked about in my last workshop last week. So yeah, I'd look into the ERC for sure. So as I was mentioning, this credit, the Emergency Paid Family Leave Credit, is an extension of the Family and Medical Leave Act, FMLA. It's often referred to as EFMLA, Emergency Family and Medical Leave Act. When someone takes leave under this, they're considered on EFMLA leave. As an extension, it includes all of the regular FMLA's job protections. While they're on leave, they cannot lose their jobs, subject to certain limitations. I don't have a ton of time to get into the FMLA's job protections, but I'd look at your own human resources policies or speak to someone familiar about that. An HR associate or the SBDC might actually be a great resource to talk to about that. But anyone out on EFMLA leave is subject to FMLA's job protections. Employees can qualify for it after only 30 days of employment. This is a big thing. For regular FMLA, you need at least a year in service, and you need to have worked 1,250 hours within that preceding year in order to be eligible for FMLA. And the reason is obvious. I mean, you don't want someone working for you for 2 weeks and then going on leave with full job protection, normally. But because of COVID and the reasons for leave also being fairly obvious, if someone's caring for an ailing family member or grieving, whatever it is they're doing, you want eligibility after 30 days. So that's what the law did. Employees can qualify for EFMLA after 30 days. And in that situation, you as the employer would be eligible for credit for the wages that are paid, keeping in mind that FMLA is often unpaid. But if you choose to offer, payment to the employee out in EFMLA leave, you can recoup what you pay them up to that limitation through the credit. So it's a win for the employee. It's a win for the employer. It's just a nice thing to do if you can manage it. So things to keep in mind. Like I said, the sick leave and family leave that was mandatory in 2020 became voluntary in 2021. But you still have the option to offer it and claim these credits. Now, in order to claim these credits, it's another situation where you're immediately entitled to receive the credit in full, plus related health plan expenses and your employer's share of Medicare tax on the qualified wages paid. That's everything that you can lump into this credit. You can claim this credit between, for quarters between March 2020 and September 2021. That's what this all runs through unless it's extended again. The refundable credit, it's applied against certain employment taxes on wages paid to all employees. This is different than the employee retention credit, which requires that you offset against Social Security for 2020 or Medicare for 2021. All the guidance I've seen thus far says that you can withhold from virtually any payroll taxes to be remitted to the IRS. You can also do the thing where you file a Form 7200, request for advance payment of employer credits, to request a sooner payment of the credit. It's an advance credit, so you can request it be paid as soon as you become eligible for it or believe you're eligible for it. I typically recommend folks wait at least until the end of the quarter so that their eligibility can be pinpointed with some degree of certainty. But then you can file the 7200. The IRS takes a while to process those, I'll add. Those forms 7200. If you submit one, I'd expect it to take at least a few weeks for the IRS to process and remit payment. In good times, we're in tax season now with deadlines being shuffled and extended and people filing their corporate and personal income tax returns, partnership returns, et cetera. So you can expect a bit of a backlog from the IRS, but they're doing a lot with what they've got. Now, there was a few, for people who have claimed this in 2020 or who are tuning in to see what's changed with the latest stimulus, there's a lot that's changed. Let me just double check my time here. Okay, I've got time. Okay, so some changes that were made with this latest rescue plan, and I've got something in the Q&A. Okay, that's been answered. All right. So extended the availability, first and foremost, for both of the credits through September 30th of 2021. It added retroactively applicable non-discrimination language to the tax credits. So if you're discriminating with regard to who is eligible for this leave in favor of highly compensated employees, in favor of full-time employees, or on the basis of employment tenure, you won't be able to obtain the credits for any leave paid under the framework set out in the stimulus legislation from last year. It is a big change because people who thought they were eligible for these credits, employers who thought they were eligible, might suddenly find themselves ineligible based on that discrimination. So double check what you've already claimed, double check what you mean to claim, make sure you're not discriminating in favor of some employees over others here. This looks very similar to other anti-discrimination language found in other employee benefits laws, but it is different. The full-time employees thing is important. So keep that in mind. That is new with this latest stimulus bill. It extends the availability through September. It refreshes the 80 hours pool. The idea with this being employees were given 80 hours or 2 weeks of sick leave they could claim within a 1-year span, and these credits are now extending beyond the year. So if you claim the credit for 80 hours between, April 1st of 2020 and March 31st of 2021, basically Q2 2020 through Q1 2021, if those 80 hours were exhausted, it rolls, it refreshes as of April 1st, 2021. So you can claim the credit again for those last 2 quarters of this year. The entire bank rolls over. They can take the 80 hours at any point within those 2 quarters of 2021. So, don't feel the need to discontinue this for people who've taken their 80 hours at this point. Let's see here. Already covered the non-discrimination language. It expanded the reasons for getting EPSL and EPFL to include getting the COVID vaccine, like we talked about, and employer's request. A big change, the EPFL, the Emergency Paid Family Leave credit, used to only be usable for someone taking time off to care for a child or to provide certain quarantine-related care services. This latest law expanded the EPFL to include all of the qualifying reasons allowable for the EPSL. So now if someone is out sick with COVID for more than 2 weeks, you can transition them over to the EPFL if they're eligible under the EFMLA rules. That gives them an expanded buffer of paid time off, albeit at a lower rate, as we talked about. One of the big changes that happened, and we're still waiting for guidance from the Department of Labor on this. Like I said, it used to be that someone would claim the EPSL for 2 weeks while EFMLA leave was unpaid. Weeks 1 and 2 of a 12-week EFMLA leave would be unpaid. And then weeks 3 through 12 of EFMLA would be paid, albeit at that lower rate. They've changed this to where the EFMLA leave is paid from day 1. So you no longer have to go on EFMLA and start that period while you're being paid EPSL, you can now start EFMLA and get the EPFL credit once EPSL runs out. So you can use the sick leave and then go on to EPFL. What's unclear here is if you can stack them and use them back to back in that manner where you get 2 weeks of EPSL leave and then 12 weeks of EPFL leave, all paid for a total of 14 weeks. I believe that was the legislative intent, and I believe that's the guidance we'll ultimately get, but I'm not 100% certain on that. So it's worth doing a little bit of digging, maybe checking back with me or another lawyer or your CPA or someone who would be able to dig up that answer once guidance is provided. Now, the IRS has posted some FAQs for how these credits work mechanically. It gives you all of the technical standards for who's eligible and how to claim them, how to offset against your payroll taxes. Very important to do that right. It's worth checking out. It is a stimulus bill behind. It does not take into account this latest stimulus bill passed in January, or no, I'm sorry, passed in, when was the latest stimulus bill passed? Anyway, it doesn't take into account the latest stimulus bill, but I expect it will within maybe 2 weeks. So keep checking that resource often, as well as the other IRS resources. Now, the last credits we're going to talk about, and I'm just going to double check time one last time. I've got time. We're good. Last credits we're going to talk about are the credits for sick leave and family leave for self-employed individuals. These are very relevant for self-employed individuals, people who are not on their own payroll. They would extend typically to LLCs treated as sole proprietorships, and to some extent partnerships. The mechanics are a little unusual, but there's a form that walks you through the calculations. Self-employed persons can claim the employer paid sick leave and family leave credits. That's new with this latest law. You'd use a certain IRS form 7202 to determine the extent of your eligibility for these credits. It is a worksheet where you calculate your eligibility based on net earnings for the venture. To qualify, a self-employed person must conduct a trade or business that qualifies as self-employment income, which should be sole proprietorships, LLCs treated as disregarded entities, and partnerships. You pay self-employment tax on your income from all of those, so you should be able to factor this in. You must be eligible to receive qualified sick or family leave wages under the EPSL or EFMLA as though you were an employee. And what that means is you have to get paid the wages. You have to take the time off because of qualifying reasons. The credit is limited to what the credit would be limited to for regular employees. And the time and service rules for EFMLA still hold. So you need to qualify under those credits in that sense. But this extends to self-employed people who wouldn't otherwise be on their own payroll. Some other eligibility considerations. Again, qualified use of leave remains the same. Qualified wages, it's tricky to compute, but 7202 walks you through the process with a series of percentages based on the net earnings of the company. The instructions are fairly long for that form. It's another thing that your accountant would probably do for you, but that will determine the amount of your qualified wages that will be eligible for the credit if you choose to pay them and then claim the credit. It's a boon for self-employed people. I would recommend not leaving this on the table if you're self-employed and took any time off for these reasons. I'll end the presentation with a note, as I end every time: utilize your resources. It's just, you don't want to leave money on the table, and you also don't want to do things improperly, because like I said, payroll taxes, if you mess up and not pay to the IRS something that you're required to pay them, they will come after you, and they'll come after you personally. So it's worth first, talking to your accountant or CPA to make sure you're doing this right and maximizing your use of credits. But also, this is one of these really this is one of those topics where I really have to say, go talk to the SBDC, because they have a lot of resources and no cost counseling that's going to help you figure out, based on your unique situation, what you're doing right or wrong, or could be doing better. They can point you towards other helpful resources, towards accountants or attorneys who can help you sort out your situation. I mean, they're a great first resource to reach out to. So if you haven't already set up a no-cost counseling session, really give that a thought, because as an attorney, I consult with people all the time on their business and tax considerations, but it's not no cost, and it's just a great resource to avail yourself of. So check out that link. Um, we'll do the Q&A, but before I do the Q&A, I also want to point out one other thing on this next slide here. If you don't already have an accountant or CPA, there's a resource with the New Mexico Society of CPAs. It's the Find a CPA tool. They can help you find someone local to you who is a registered and qualified CPA. So a CPA is a certified public accountant. Anyone can be an accountant if they have certain basic training and credentials, but a CPA goes through an extensive licensure process, background check. They're held to quality standards. Complaints are investigated against them. So if you really want to find a high caliber accountant, I'd recommend a CPA. So check out that link. Now, the rest of this will be dedicated to Q&A. We've got a few questions in the queue. I've answered all of those already. So does anyone have any questions? I've reserved this next block of time for questions. So give me what you got.
Ian, I see that we have a phone-in caller. I'm going to go ahead and allow that person to talk should they wish to, as they're unable to type a question in. You
Okay.
do not need to talk if you don't want to. I'm just going to allow you to talk. You'll still be muted, but you can unmute yourself if you'd like to. And yeah, anyone else who has questions, please go ahead and type them into the Q&A or raise your hand and I can allow you to talk.
Well, if there are no questions, then we'll go ahead and wrap up with this. Definitely check out the SBDC for the resources I mentioned. You'll be getting a survey email after this presentation. So just go ahead and fill that out. I remain available to answer more questions. You can submit them to me through the SBDC. They usually forward questions to me for answer later. So if you come up with more questions, or if maybe I missed something, or whatever the situation is, just go ahead and reach out to me and I'm happy to get in touch with you.
Thank you so much, Ian, for all the information and, as always, your expertise. And thank you all for joining. Don't forget to visit us at nmsbdc.org should you wish to sign up for our no-cost counseling training or any upcoming training events that we are having. Thank you again. I appreciate it.
Thank you.